Welcome to IAS Project. In this video, we will be talking about IMF. The origins of IMF lie in Bretton Woods Conference of 1944. IMF headquarters is located in Washington, D.C. When IMF was founded, it was founded by 44 founding members. India was also a founding member. As of now, IMF has 190 members. Out of 190 members, 189 are UN countries, and also there is Kosovo, which is a member of IMF. IMF is governed by and accountable to its 190 member countries. IMF is headed by a managing director. Managing director from establishment of IMF onwards has always been a European. However, this is not written anywhere in the articles of agreement of IMF. This is just a convention. IMF Managing Director serves for a 5-year term, and then reappointment is also possible. Let's look at the history of Bretton Woods Conference. The actual name of Bretton Woods Conference is UN Monetary and Financial Conference of 1944. It was held to regulate international monetary and financial order after the conclusion of Second World War. As we know, Second World War started in 1939 and it finished in 1945. So Bretton Woods Conference and establishment of IMF actually happened during the period of Second World War. The famous economist John Maynard Keynes is seen as the Bretton Woods architect. During the Bretton Woods Conference, agreements were signed to establish two institutions. They are International Bank for Reconstruction and Development, which is now a part of World Bank Group, and the second organization is IMF. We will study about IBRD in our World Bank video. IBRD along with IMF are called as Bretton Woods twins. IMF and World Bank together constitute the Bretton Woods system of international commercial and financial relations. Both World Bank and IMF are also specialized agencies of UN. Main objective of IMF was to ensure global monetary stability. Monetary stability here means especially in terms of exchange rates. This was actually the main concern during Second World War. Main objective of IBRD was reconstruction of post-World War II Europe. Let's look at IMF organizational structure. IMF organizational structure, at the top we have a board of governors, which is the highest decision making body and has all the powers of IMF. The board of governors consists of one governor and one alternative governor from each country. The governor and alternate governor are appointed by respective country members for each country. So we have 190 governors and 190 alternative governors. Generally, governor is the finance minister and the alternate governor is the head of central bank. For example, in the case of India, it would be finance minister and RBI governor. Voting share of every country is as per their allotted quota and shares. Only board of governors can approve quota increases, SDR allocations, they can admit new members and amend articles of agreement. Only board of governors has a right and authority to do all these functions. Rest of the functions have been allotted or allocated by board of governors to executive board. So it is a kind of devolution of powers. Executive board is made up of 24 members and it is chaired by IMF Managing Director. IMF Managing Director is actually appointed by IMF Board of Governors. IMF MD is also the head of IMF staff. Powers to Executive Board are actually delegated by Board of Governors. There are two ministerial committees which assist IMF in its job. The first one is IMFC, which is also called as International Monetary and Financial Committee. It is made up of 24 members and it is a purely advisory body. It advises IMF Board of Governors in their functions related to global financial systems and monetary stability policies. We also have a development committee which has 25 members, and it is also an advisory body. Board of Governors of IMF and World Bank are advised by Development Committee. Development Committee advises Board of Governors of IMF and World Bank on issues relating to economic development of emerging markets and developing countries. Let's see what IMF actually does. Main objective of IMF, as we have stated, is to maintain monetary stability at global level. Monetary stability simply means to maintain exchange rates. IMF lends to countries that face balance of payment crisis. Therefore, IMF acts as a lender of last resort for countries facing balance of payment problems. IMF has three critical missions. The first one is to further international monetary cooperation. The second one is to encourage expansion of trade and economic growth. And the third one is to discourage such policies that harm prosperity. This mission is actually very wide, therefore includes various aspects like anti-money laundering, countering financing of terrorism, promoting transparency in policies, surveillance of members, to provide technical assistance to members, and many others. IMF also has other functions like surveillance, technical assistance, and capability development, although these are not directly mentioned in the critical missions of IMF. There is a high level of coordination between IMF and World Bank. Any member can join World Bank only first he has to become member of IMF. Boards of Governors of IMF and World Bank meet annually, along with IMFC, that is International Monetary and Financial Committee. World Bank actually is an observer at IMFC. Boards of Governors of IMF and World Bank also meet annually along with Development Committee, G10, G24, and other bodies, and they mainly discuss policy issues. Let's learn about IMF Quota. Every member, when he joins the IMF, has to pay certain amount to IMF, and this certain amount is actually a mix of widely accepted foreign currencies like US dollars, euro, Japanese yen, etc., or they can also pay SDRs, and along with foreign currency or SDRs, they have to pay some amount of domestic currency of that member. Usually it is in ratio of 25 to 75%. 25% comes in the form of foreign exchange and 75% comes in the form of domestic currency. So each member has to pay this amount when they join IMF. This amount is actually denominated in SDRs. SDR stands for Special Drawing Right. And this amount is called as quota of that member. Quota of a member broadly depends on relative size of economy of the member. For example, a member like Sri Lanka would pay a smaller amount of quota, and a member like China or USA would pay a large amount of quota. Quota reviews are conducted by IMF Board of Governors once in every 5 years, or sometimes even before, because the relative size of economy of members on global stage changes with time. For example, fast developing countries like India and China are growing in their relative size of economy with respect to the world. So relatively, regularly their quota has also to be adjusted. So to approve the quota revision of any member, 85% of majority voting share of Board of Governors is needed. Also, members must consent before any such revision of quota. If we see the actual shareholding of different countries, for example, US has almost 17% of quota and shareholding in making decisions. So if we see this logic like this, to approve, for example, if India's quota needs to be increased, if USA does not want it, 85% of majority voting can never be reached. So in a way, USA kind of maintains a veto power when it comes to revision of quota of countries in IMF. A general quota revision can be of two types. The first type is where there is a change in share of the member in the total quota of IMF. And the second type is where there is no change in the share of the member in the total quota of IMF. Let's understand this further. For example, let us say, for example only, the total quota of IMF is 100 SDR. And from this 100 SDR, different countries are allotted some numbers. For example, India has 2, USA has, let's say, 16, China has, let's say, 7, and something like this. If the total quota of IMF is made 200 from initial 100 SDR, then there is some kind of arrangement like this can be made. For example, India's 2 SDR can be made into 4, USA 16 can be made into 32, and China 7 can be made into 14, such that there is no relative change in the percentages or the shares compared to initial and final. Or there can be a matter such like, for example, initially there is 100 SDR quota of total of IMF, and this 100 is changed into, let's say, 105. Initially India's was 2, USA was 16, China was 7. Now this 5 is, let's say, added to India only, 7, and this remains 16, and this remains 7. So only India's share has increased and the other share has actually decreased, because previously it was 16 divided by 100, now it is 16 divided by 105. So the remaining countries' share has decreased and India's share has increased. Here the share of all the countries is same as before. So there are two types of quota revision which can be done. Quotas determine a member's subscription to IMF, its voting power, as well as its borrowing limit. So if a member has higher quota, it simply means that members' subscription to IMF, that is the amount of money they have to give to IMF, also increases, and the voting power of the member also increases. And in case of balance of payment crisis, the member can also borrow more money. Let's look at what are special drawing rights. Special drawing right is an international reserve asset created by IMF in 1969. It was mainly created to supplement the member countries' official reserves. As of date, a total of 660.7 billion SDRs have been allocated. This includes the largest ever allocation of almost 456 billion SDRs which were allocated recently. The value of special drawing right is based on a basket of 5 currencies. This basket is not always fixed. Also, a currency may be removed and a new currency may be added if that currency loses or gains importance. So as of now, the 5 currencies are US dollar, Euro, Chinese yuan or renminbi, Japanese yen and British pound. Also, the weightage is also in the same order. That is, US dollar has higher weightage than Euro, which has higher weightage than yuan, then yen, and then British pound. So the weights of these 5 currencies are reviewed once every 5 years. They are not fixed. It does not depend on the size of economy as such, but the country's currencies has to be freely usable. For example, in the future, even though India becomes a very large economy, let's say compared to compared to Britain, British pound may still be in the basket of SDR currency than Indian rupee, because British pound is highly usable. IMF lends in units of SDRs. These SDRs can then be exchanged for national currencies of different countries. So SDR is neither a currency nor a claim on IMF. This is very important point from the point of view of competitive examinations. So SDR is neither a currency nor a claim on IMF. It is rather only a potential claim on freely usable currencies of IMF members. SDRs cannot be traded in forex market like we trade US dollars or euros. They cannot be traded. SDRs cannot be traded in forex market. Also, private entities like people or companies cannot hold SDRs like they hold US dollars or euros. Let's look at IMF finances and lendings. IMF resources mainly come from IMF capital subscriptions, that is quotas, that is the amount member countries give to IMF. IMF supplements these quotas with the borrowing of additional funds from some countries and institutions through arrangements like GAB and NAB. Each member is allotted a quota, and this quota goes towards capital subscription of IMF. Quota of IMF member is broadly based on its relative position in world economy. IMF lends to countries in financial difficulty from this pool, that is capital subscriptions as well as arrangements to borrow. IMF lending can be under concessional rates or non-concessional rates. Also, terms and conditions may apply. For example, IMF may put austerity measures. For example, it may say cut down on development expenses. It may say increase prices of petroleum by increasing the tax on petroleum. It can say increase income taxes or any kind of conditions like open markets to foreign goods or increase privatization and liberalization, like that. Such kind of conditions may apply. Or it can provide outright loans without any kind of conditions. Let's look at further into IMF finances and lending. IMF has different mechanisms and facilities for lending. The first one is PRGF, which is also called as Poverty Reduction and Growth Facility. It is available mainly to low income countries and it is available at concessional interest rate. Then there is ESF or Exogenous Shocks Facility. It is provided as a policy support and financial assistance to LICs which face global shocks. And the third one and most important one is standby arrangements. Standby arrangements are non-concessional loans for balance of payments crisis. Sometimes along with standby arrangements, a member country which is receiving the IMF payment may also opt for EFF, which is called as Extended Fund Facility. Through Extended Fund Facility, IMF puts conditionalities as we have discussed in the previous slide. As conditionalities are achieved one by one in a stepwise manner, IMF releases further and further tranches of funds. For example, let's say $10 billion of fund has been granted by IMF under EFF. It has put, let's say, 4 conditions. It can say if you reach one condition, we will give you $2 billion. If you reach second, we will give you 3 additional billion dollars. And if you reach third condition, we will give you 3 more. And if we reach all 4 conditions, then we will give you the remaining $2 billion also. So these are called as tranches. So the first tranche is $2 billion. The second tranche is $3 billion. The third tranche is $3 billion. And the fourth tranche is $2 billion. These IMF conditions are also known as Washington Consensus. Let's look at India's history with IMF. India sought IMF support in the past. These are the years when India sought IMF support. These 4 years it sought SBA arrangements. IMF also sought Extended Fund Facility during 1989. However, it must be remembered here that during 1991 New Economic Policy, India did not go for Extended Fund Facility, that is conditionalities, because India did all the LPG reforms on its own, not as a force or conditionality from IMF. India did not approach IMF for borrowing after economic reforms of 1991. Even India recently provided a loan of $12 billion in the form of new arrangements to borrow during sovereign debt crisis which was happening in Europe. Let's look at important reports by IMF. The first and most important report is World Economic Outlook. The second one is Global Financial Stability Report. And the third one is Fiscal Monitor. Let's look at some of the previous questions asked in UPSC Civil Services Examination Prelims. In 2016, this question was asked. Recently, which one of the following currencies has been proposed to be added has been proposed to be added to the basket of IMF's special drawing rights? We know ruble was never there, rand was never there, India was never there, only Chinese renminbi was added recently. The second question was also again asked in 2016. This is a very simple question. Global Financial Stability Report is prepared by, of course, IMF. The third question, with reference to IMFC, consider the following statements. The first one is, IMFC discusses matters of concern affecting global economy and advises IMF on the direction of its work. Yes, it is right. It is basically an advisory body to IMF. The World Bank participates as observer in IMFC's meetings. This is also right. We have stated this in the previous slides. So the answer is both 1 and 2 are correct. Let's look at 2018 question. India enacted GI of Goods Act, Geographical Indications of Goods Act 1999, in order to comply with the obligations to not ILO, not IMF, not UNCTAD. It is actually World Trade Organization. We will discuss this in our World Trade Organization video. That's it for this video. Please like, share and comment on this video and subscribe to IAS Project. Thank you.